You asked, and I did not answer completely, the analyst question, how we put our research out there. So our analysts they have domain expertise for the most part in the new world, one foot in the new world. Why? Because they've just been educated in CRISPR gene editing and have experimented with it themselves, or they've worked in the industry. I mentioned James Wang coming from NVIDIA. Well, NVIDIA is the AI chip company. James already had a wide network in that space. It has grown even wider because of how we do our research. First principles is, okay, what is an autonomous vehicle? That Tasha, Sam Corris, who follows battery technology and robotics, Tasha, and James Wang, who follows artificial intelligence. The three of them work on that model together. So think about that. Very collaborative, no turf fights. In fact, we're all trying to seek the truth. That's our mission. We are also trying to engage with the communities we are researching. We want to become a part of those communities. And in many ways, we have become a part because we are willing to give our research away. We are, I often call ARC one of the first sharing economy companies in the asset management space when it comes to research. We are giving our research away. We are putting our Tesla model up on GitHub. We just put our Square model up on GitHub. Whenever we feel there's a glaring inefficiency in the way that a company is being analyzed, we're going to put it on our models on GitHub, just so other analysts and other people just interested in the space can experiment with them and scenario test them. We leave the variables open so others can battle test our assumptions. And so we have become a part of those communities, and we're getting information. It is not, this is very important from a compliance point of view. This is the information we're getting is not material, non-public information. It is simply trying to understand how the world's evolving generally. And those who are doing the innovating have a really good idea of how it's evolving. What we have to offer for them is we are trying to size the markets they're going after. We're trying to figure out where the unit economics are going to be, where's the profit margin in this particular space going to land, and which parts of this space will be commoditized. So in the case of Tesla, we think battery cells are commoditized. But we do not think that about battery pack systems, which is what Tesla does and what Tesla is going to build into the floor of its cars. Talk about vertical integration. So we are helping those innovators say, hey, this is how we're thinking about the world. Where could we be wrong? Well, they want to understand where their world is going from a financial point of view as much as we do. And so they want to help us do our work. And so it's a win-win situation. And as you can see, it's transparent. We're tweeting with these researchers, or about them, or with them, and we're on this journey together. And we want our clients, to the extent they want to be on the journey, in terms of in the weeds and understanding why we're doing what we're doing, we're happy to have them join us. Enough so that we post our trades at the end of every day. And we get, I can't believe how popular that has become. Many people might be using our trades for their own, personal accounts. That's fine. But what you'll find, many in the ETF world didn't think that a fully transparent active equity ETF was possible. And the reason they didn't is because many growth managers are momentum driven. We are not. We are, some people would say we're aggressively patient. Certainly you can see from the moment we started ARC 2014 to its breakout point last year, we were in a huge trading range and everybody saw our trades. They're beginning to understand that we are lying in wait for misperception and controversy to visit a stock. And we will buy. So we are a liquidity provider in the marketplace. That's why we don't mind being transparent with our disclosing our stocks at the end of every day, or our holdings, and our trades at the end of every day. Because if a stock is getting beaten up by some short-term thinking, we are usually there picking it up. And we don't mind company when it's down 20, 30%, you know. And on the other side, we don't mind company if the stock is hyperventilating. You know, analysts have decided that NVIDIA is there, check the box for artificial intelligence. We are quite happy to see NVIDIA going up, and we're quite happy to take profits as it does.
I think so. It's one of the things that I think is very clear to listening to that perspective is how you fit well with the Bitcoin community. One of the things you'll see constantly is when people who are thinking short term, maybe that's because their mandate leave the space. The hodlers flood in and say basically thank you for the sats. You know, I mean, and the thing that's interesting is that you see kind of a rising price floor each cycle because of that. But before we get into Bitcoin, I want to just stay on Tesla for just a minute. I guess actually it's a broader question than Tesla, but one of the things that I tend to see when it comes to, you know, I came out of a Silicon Valley perspective, and now I pay more attention to kind of traditional markets. And I think that there's this perception of innovation as a venture capitalist thing. Mm-hmm. Right? Where you're winner picking almost exclusively. And so I guess, you know, how does your research process differentiate you from the work of, say, a late stage venture capitalist who maybe is starting from a similar macro place as you, but isn't thinking in terms of day-to-day trades?
Right. What the biggest surprise to me in doing the research we've been doing and sharing is that when we engage with innovators, let's say, and they may have VC owners, the venture capitalists are not doing the kind of research we're doing, this first principles based, you know, I mean, when you think about it, our autonomous vehicle, autonomous truck, drone models, they started in 2014, 2015, and they are evolving. We're going, as the technology progresses and the costs drop, our models are becoming even more useful to us. And why is that? Because the venture capital world, they will only go so far, and then they want a liquidity event. The world we're looking at, and we call ourselves the closest you'll find to a venture capital firm in the public equity markets, we believe that these opportunities, the platforms, the technologies, are the seeds for all of them were planted in the tech and telecom bubble. We weren't ready for prime time back then, and it ended badly back then. But 15 to 20 years of gestation of these new technologies, they are ready for prime time now. It's interesting that many people are nervous about the volatility now that they're ready to take off, but they didn't mind the volatility during the tech and telecom bubble. So, but whereas VCs will be looking for that liquidity event and they're out, we think they're leaving so much on the table because these exponential growth opportunities have just begun. They've just begun, and you actually need the public equity markets to fund the kind of trajectories possible here. And you know, it's interesting. I am very happy when I see one of our companies saying, we're doing a deal, we're doing an offering. And why am I happy? Because we want our companies to invest aggressively now. The more they invest now, the better shot they have of capturing the lion's share of whatever market they're going after, because so many of these exponential growth opportunities are powered by artificial intelligence, and the companies with the largest amount of data and the best data and the best understanding of how to label the data are going to win. And so these are winner take most. And if we're on the right horse, as I think we are, just to go back to your Tesla or our Tesla, I think they're in the pole position for the autonomous taxi network in the United States. And we're even surprised in China at how well they're competing against the Chinese incumbents. And we're trying to figure out, wow, could they get a piece of that autonomous action as well? That would multiply the opportunity manyfold where we are right now.
I actually want to come back to the geopolitics of innovation. I think it's a really interesting question for you. But one more kind of piece that connects to what we were just discussing. How do your models take into account or intentionally ignore when there is momentum, when there is narrative, right? So obviously this year has seen a large narrative around the retail day trader set rising, right? Is that something that you guys kind of just, it's too short for your time scale, or is it something that, doesn't really change your long-term conviction, but you're still going to pay attention to?
Right. So our investment time horizon is 5 years. And the minimum hurdle rate of return for any stock to get into our portfolio is a compound annual return of 15%. So that's a doubling over 5 years. That's our minimum hurdle. So when we see short-term trading, if you watch our trading, you'll see we are, as I said before, a liquidity provider. We'll be very opportunistic around it. And just to give you an idea of how productive that can be, if you look at just Tesla, let's just take Tesla in 2018, which was a down year for the market. Take away Tesla's performance, which actually was up for the year, but take that away and just look at the contribution to return that our trading accounted for. In 2018, it was 175 basis points in a down market. And I believe in 2019, it was roughly 200 basis points, right? So in a market where many think as we're seeing from the S&P 500, we're up 5-6% for the year in the S&P 500. If you can get one stock like a Tesla, and we do this for all of our stocks, to deliver, 175 to 200 basis points just because of wild trading, that's nice alpha generation.